$481 billion. That's how much money is sitting on U.S. bank balance sheets right now as unrealized losses. Not theoretical losses, not maybe losses, real losses that just haven't been officially recognized yet because the banks haven't been forced to sell the assets. To put that in perspective, that's more than the entire GDP of Norway. It's sitting there like a financial time bomb, and most people have no idea it exists. On January 30th, 2026, one of those time bombs went off. Metropolitan Capital Bank in Chicago became the first bank failure of the year. The FDIC seized it on a Friday night, transferred the deposits over the weekend, and by Monday morning, it had a new name on the door. Most people didn't even notice. But I did, because I've been tracking bank balance sheets, and what happened to Metropolitan Capital is a symptom of a much bigger problem that's affecting hundreds of banks across the country right now. Let me show you what's really going on. Here's something most people don't notice. When the FDIC closes a bank, they almost always do it on a Friday night after markets close. Metropolitan Capital seized Friday, January 30th around 5 p.m. Central Time. This isn't a conspiracy. It's standard operating procedure, and it actually makes sense. If you shut down a bank on a Tuesday morning while markets are open, you risk triggering panic withdrawals from other banks. Depositors at similar institutions might freak out and start pulling their money. By Friday evening, you've got the whole weekend to transfer deposits, communicate with customers, and let the news cycle cool down before Monday morning. By the time you wake up on Monday, your local branch just has a different name on the door. First Independence Bank, in this case. Your money's still there, your debit card still works, and most people don't even realize their bank just died. Is this manipulative? Maybe. But it prevents bank runs, and bank runs are how you turn one bank failure into 5. So yes, the FDIC has a playbook, and yes, Friday night is when they execute it. That part isn't fiction, and it makes sense. Metropolitan Capital Bank wasn't some massive institution. They had $261 million in assets, one office in Chicago, one in New York. They'd been around since 2005. So what went wrong? According to Illinois regulators, the bank was closed due to unsafe and unsound conditions and an impaired capital position. That's regulatory speak for, this bank is bleeding money, and we need to pull the plug before it gets worse. Here's what we know from court records and regulatory filings. Metropolitan Capital was tied up in a bad commercial real estate loan to a guy named Zvi Feiner, who ran a portfolio of nursing homes called Rosewood Care Centers. That loan went sideways. The Department of Justice eventually charged Feiner with running a Ponzi scheme. The bank had been on thin ice for years. Back in 2019, they agreed to a consent order with the FDIC and Illinois banking regulators. They were required to maintain minimum capital levels, reduce bad loans, stop paying dividends without permission, and improve their management practices. At one point, nearly 10% of their loans were delinquent. They tried to survive. They extended the loan multiple times. They restructured. They did what's called extend and pretend in the industry, basically hoping the borrower would eventually pay up. But the nursing home properties never recovered. The loan defaulted, and Metropolitan Capital ran out of capital to absorb the loss. The FDIC stepped in. The bank failed. Cost to the Deposit Insurance Fund, about $19.7 million. Now here's why this matters. Metropolitan Capital didn't fail because of one bad loan. They failed because they were exposed to commercial real estate at exactly the wrong time in history. Here's how banks actually work, because this is important. When you deposit money in a bank, that money doesn't sit in a vault with your name on it. The bank takes your deposit and lends most of it out. They might buy bonds, they might make commercial real estate loans, they might lend to businesses, and as long as those investments are performing and the borrowers are paying, everything looks fine on paper. But here's the problem. In 2022, the Federal Reserve started raising interest rates at the fastest pace in 40 years. They went from basically 0% to 5.33% in about 18 months. When interest rates go up, the value of existing bonds goes down. Why? Because if a bank bought a 10-year treasury bond that pays 2% interest back in 2020 and new bonds are now paying 5%, nobody wants that old bond at face value. They'll only buy it at a discount. So you've got banks sitting on bonds that say they're worth $100,000 on paper, but if they tried to sell them today, they'd only get $85,000. That $15,000 difference is called an unrealized loss. As of the end of 2024, U.S. banks are sitting on approximately $481 billion in unrealized losses on their securities portfolios. Some estimates put it as high as $515 billion. Now, here's the key thing. These losses don't show up on a bank's income statement as long as they don't sell the bonds. They're marked as held to maturity, which means the bank plans to just hold onto them until they mature and collect the face value. But if depositors start pulling their money out, the bank has to sell those bonds to raise cash. And the moment they sell, the loss becomes real. The bank takes a hit to its capital. And if the bank doesn't have enough capital to absorb that hit, the bank fails. This is exactly what happened to Silicon Valley Bank in March 2023. They had about $60 billion in bonds that had lost roughly $16 billion in value. They were fine as long as nobody asked for their money back, but their depositors got nervous. Withdrawals accelerated. SVB had to sell bonds at a loss. The loss wiped out their capital buffer, and the FDIC had to step in and seize the bank. Same thing happened to First Republic. Same thing happened to Signature Bank. All in the span of 72 hours. Right now, as of late 2024 and early 2025, the banking system has more unrealized losses sitting on balance sheets than it did when SVB collapsed. Let me say that again. The problem that killed 3 banks in 2023 is worse now than it was then. But wait, it gets better. The unrealized bond losses are only part of the story. The real nuclear bomb sitting in the basement of the regional banking system is commercial real estate. U.S. banks hold about $3 trillion in commercial real estate loans. Not all of it is bad, but a significant chunk of it is tied to properties that are struggling or outright failing. Here's the breakdown. Analysts estimate that about $1.2 trillion of that CRE debt is potentially troubled. That means the properties backing those loans are losing value, tenants are leaving, or borrowers are struggling to make payments. Of that troubled debt, roughly $626 billion in office debt alone is maturing by the end of 2025. And in 2025, about $957 billion in total CRE loans came due. Why is this a problem? Because most of these loans were originated back in 2015, 2016, 2017, when interest rates were low and office buildings were fully leased. Borrowers locked in 3% or 4% financing on properties that were worth top dollar. But then the pandemic hit. Remote work became permanent for a lot of companies. Office buildings went from 90% occupied to 60% occupied. Some went lower. Rent revenue collapsed. Property values dropped. Now those loans are coming due, and the borrowers can't refinance. Why? Because interest rates are higher, property values are lower, and lenders don't want to touch underwater office buildings. So what happens? The borrower defaults. The bank takes the building as collateral. But the building is worth less than the loan balance. The bank takes a loss. And if the bank takes enough of these losses, the bank fails. As of the fourth quarter of 2024, 59 of the 158 largest banks in the United States have commercial real estate exposure greater than 300% of their total equity capital. Bank regulators view anything over 300% as excess exposure that puts the institution at greater risk of failure. That's not speculation. That's regulatory data from the Federal Financial Institutions Examination Council. Now, I want to be clear. This doesn't mean 59 banks are about to fail tomorrow. Most of them will survive. They'll extend loans, they'll restructure, they'll raise capital, they'll find ways to manage the problem. But some won't. And Metropolitan Capital was the first one to go down this year. Let me give you the real numbers on office occupancy, because there's a lot of misinformation out there. As of December 2025, the national office vacancy rate was 18.4%. That means about 81.6% of office space is still leased. But here's the nuance. Vacancy rate measures how much space is leased, not how many people are actually showing up to work. Office attendance, meaning butts in seats, is running at about 51% to 56% of pre-pandemic levels nationally. Some cities are doing better. Houston and Dallas are above 60%. Austin hit 92% midweek occupancy in some data sets. Manhattan is pushing close to 60% weekly average. Other cities are struggling. San Francisco has a 22% vacancy rate. Seattle and Austin have office vacancy rates around 27%. The point is, the office market is not uniformly collapsing, but it's also not going back to 2019 levels. Hybrid work is permanent. Companies have realized they can run with less office space. And that means a certain percentage of office buildings, especially older, less desirable buildings in secondary locations, are never going to fill back up. Those are the properties tied to the loans that are defaulting. And those are the loans that are sitting on bank balance sheets right now. Banks are sitting on $481 billion in unrealized bond losses. They're holding $3 trillion in commercial real estate loans, with over $1 trillion of that debt considered troubled or at risk. And 59 of the largest banks have CRE exposure over the regulatory red flag threshold of 300%. Metropolitan Capital was the first bank to fail in 2026. There were only 2 bank failures in 2025. 2 in 2024. So we're not in a full-blown crisis right now, but we're also not out of the woods. The question is what happens if another bank fails? If depositors at regional banks start getting nervous and moving their money to the big 4, JP Morgan, Bank of America, Wells Fargo, Citi, because they figure those banks are too big to fail. That's when you get a domino effect. One bank fails, depositors at similar banks panic, they withdraw funds, the next bank has to sell bonds at a loss to raise cash, and suddenly you've got 3 or 4 banks going down in a week. We saw it in 2023 with SVB, Signature, and First Republic. It happened in 3 days. Could it happen again? Yes. Is it guaranteed? No. The banking system is better capitalized now than it was in 2008. Regulators are watching CRE exposure closely. The FDIC has tools to step in and manage failures without triggering systemic panic. But the vulnerabilities are real. The unrealized losses are real. The CRE exposure is real. And if you're sitting on a 6-figure bank balance at a regional bank with heavy commercial real estate exposure, you might want to know which bank you're dealing with. I'm not here to tell you to panic. I'm here to give you information so you can make informed decisions. First, understand FDIC insurance. Your deposits are insured up to $250,000 per account, per institution. If your bank fails, you get your money back up to that limit. If you have more than $250,000 in one bank, spread it across multiple institutions or account types. Second, know your bank's financial health. You can look up your bank's quarterly reports on the FDIC website. Check their CRE exposure, check their unrealized securities losses. If they're sitting on a massive pile of underwater office loans, that's a red flag. Third, diversify. Don't keep all your cash in one place. Consider spreading deposits across multiple banks, keeping some funds in treasury bills or money market funds, and yes, holding some physical assets. I'm not going to sit here and tell you to dump all your money into silver or gold, but I will say this. Physical assets have zero counterparty risk. They don't depend on a bank staying solvent. They don't care if the FDIC has to step in and seize an institution. If you want to hold some precious metals as a hedge against banking system instability, that's a reasonable strategy. Just don't go all in on any one asset class because someone on the internet scared you. Fourth, stay informed. If more banks start failing, you'll see it in the news. The FDIC publishes a list of failed banks on their website. If you start seeing multiple failures in a short period of time, that's when you need to pay closer attention. But right now, in February 2026, we're not in crisis mode. We're in pay attention and be prepared mode. Metropolitan Capital Bank failed because they made bad loans, didn't have enough capital to absorb the losses, and regulators decided it was time to shut them down. It's the first bank failure of 2026. It probably won't be the last. But understanding why banks fail, what the real vulnerabilities are, and what you can do to protect yourself, that's how you stay ahead of the panic instead of reacting to it. If this kind of analysis is valuable to you, let me know in the comments. What banks are you worried about? Are you seeing signs of stress in your local market? Have you moved money out of regional banks? I want to hear what you're seeing on the ground. And if you want more breakdowns like this, real numbers, real analysis, no hype, hit that subscribe button and turn on notifications so you don't miss the next one. Because I'm watching the FDIC reports. I'm tracking the CRE data, and if another bank goes down, you'll hear about it here first. Thanks for watching. Stay informed, stay rational, and I'll see you in the next one.